Hi, hello, welcome back. So here we were studying about the income of the individual, that is tax incidence of persons in different situations if they are OR, NOR and NR. Already we have worked out two problems. Today we will work out one more problem where some of the adjustments are available, some new things may be there. So we'll without any wasting any time, we'll see to the problem, we'll understand the problem, then we'll see to the solution. So you read out this problem. Naya gives you the following information. Name of the SSA is Naya. So his income during the previous year is given. Different types of incomes, whatever he received during the previous year is given here. So we are supposed to calculate his, what is asked there, his total income if he is ordinary resident, not ordinarily resident or non-resident. So this is what we are supposed to calculate. Now here there are certain items, these items we have to see, and based on these items information we have to decide what is to be done with this particular SSC. Now first one, interest on Indian companies debenture. See, any amount of interest or any type of interest what you will receive from Indian company is taxable in the hands of the SSC. Only the amount of dividend you received from Indian company is exempt from tax, not the interest. Interest on any of the securities are taxable. Now interest on Indian company is a Indian income, taxable for all the three. This 16,000 is taxable for all the three SSCs. Next, interest on fixed deposit, bank fixed deposit. Yeah, now here it is not given which country's bank it is, so we can assume or we can easily understand that it is an Indian bank or Indian income it is. So same treatment will be done as we have done it for, as we are doing it for debenture. So same thing, interest we have received, I told dividend is exempt, interest is not exempt, it is fully taxable. So 15,000 is taxable in the hands of all the SSCs, so taxable for in all the three cases. Next, he has received some agricultural income. So agriculture income, where he has received in England. If he receives some agriculture income in India, it is exempt from tax, but when it is in foreign country, it is in India it is exempt, but in foreign country it is taxable. So whole 50,000 is taxable. Now is there any connection with India anywhere? No. It is given which is remitted to India. 30,000 is remitted to India. That means it is sent to India. When it is sent to India or remitted to India, it won't affect to our problem. Only we have to see here whether it is if it may be deposited there in the bank or it may be sent to India. No differentiation will be done, so it is taxable for only one SSC, that is to the ordinary resident. Other SSCs it is fully taxable. Next comes income from house property in England deposited in a bank there. Same kind of transaction again. So here it is income from house property where in England. So in England this house property income he has received and it is deposited in a bank. He did not brought it to India, so there is no connection with India. We are writing it under only in first column, not in any other column. Next, profit on sale of building in Mysore received in India. Profit on sale of building. So the earning is done in Mysore, but received in England. That is not important. The income is from India, Indian income earned in India. So when it is earned in India, it is fully taxable in the hands of all the SSCs. So what will be the amount? So 1 lakh will be taxable for all the three SSCs. Next one. Income from how business in Singapore controlled from Bombay rupees 60,000. Half is received in India. Now we'll may divide it into two parts. First one is half received in India. So when half received in India means any amount received in India is taxable for all the three SSCs. That means 30,000 is taxable for all the SSCs. What about remaining 30,000? So total income is 60,000. 30,000 is taxable for in India. So what will be the situation for next case? So in the next case, 30,000 income from business controlled from Bombay, controlled from India. There is a condition for the income which is controlled from India, which is taxable for first two SSCs, ordinary resident and not ordinary resident, it is exempt for non-resident. Now that 30,000 is taxable for first two SSC. So what will be our solution now? So 60,000 in first column, because first received 30,000 we have, and this 30,000. 60,000 in first column, second column 60,000, third column only received in India we can write, that 30,000 we can write. So 60,000, 60,000 and 30,000. Pension from former employer in Bombay received in England rupees 40,000. So former employer in Bombay, Indian income. Indian income you have received it in foreign country, so it is taxable for all the SSCs because it is an Indian income. Bombay is in India. Indian income is taxable in the hands of all the SSCs. Past untaxed profit, when the word past untaxed profit comes, suddenly we have to remember the last condition. So as per the last condition, it is not at all taxable for any of the SSCs. So this 80,000 is not taxable for any of the SSCs. So we'll see to the solution. Before going to the solution, quickly we'll see to the things. Interest from Indian company, Indian income taxable for all. Interest on bank FD, taxable for all. Next, agriculture income in England, there is no connection with India. It may be sent to India or it may not be sent to India. In that case, it is taxable for only one SSC. Same thing, there is no connection with India, taxable for one SSC. Next, it is 1 lakh rupees income from India, foreign country receive agide. So 1 lakh rupees fully taxable. Income from business in Singapore controlled from Bombay, half is received in India, so 30,000 in all the three columns. So remaining 30,000 is taxable for first two SSCs. So 60,000, 60,000 and 30,000. Pension from former employer in Bombay. Bombay is in India, that means Indian income it is fully taxable wherever it may be received. Last one is past untaxed profit brought to India, which is exempt fully. 100% it is exempt. Solution is here. So you can see there, Indian company debenture taxable for all the three SSCs. You can see here taxable for all the three SSCs. Bank FD interest taxable for all the three SSCs. Next one, agriculture income. There is no connection with India. 50,000 is taxable for all the SSCs. There is one more amount, 30,000. We are ignoring it. It is sent to India. We are not mentioning it anywhere. So it is not considered anywhere. Profit on sale of building. So Indian income in Mysore, that sale took place, but received in England, that is not important for us. Indian income it is taxable for all, fully taxable. Next comes it is all about controlled from Bombay, income controlled from Bombay. 50% received in India. So this 50% we have mentioned here, and for remaining there is a condition which is taxable first to two. So E30,000, E30,000, 30,000 and remaining 30,000. So 60, 60 and 30. So this is what we have to understand properly. Next, pension from former employer in Bombay. Bombay is located in India, so Indian income it is taxable for all. Next, past untaxed profit brought to India during the previous year. So past untaxed profit is not at all taxable. So it is fully exempt. So these are the totals, and this is the final amount of income, his final income if he is an OR, if he is an NOR, or if he is an NR. So understand this problem and note down in your books so that it will be easy for you to study later. Thank you.